Welcome back. None of the potential headwinds facing this country, which of course include the threat of tariffs from the U.S., a weakening economy, and political uncertainty, have stopped foreign investors buying up Canadian sovereign debt. Non-resident investment in Government of Canada debt now tops $500 billion. To talk about it, we have Warren Lovely with us. He's Managing Director of Economics and Strategy at National Bank of Canada. Warren, thanks for coming in. You and your colleague have written a fascinating report on this. Tell us what's normal in terms of foreign appetite for Canadian government debt and what we've seen recently.
Well, we have in Canada a highly rated sovereign government and I think a well-developed bond market that generally attracts a good amount of foreign participation in our debt markets. But what we've seen in the 2024 data through November really is extraordinary. Just a consistent amount of foreign buying that has really been a welcome relief. We're worried about our ability to export goods and services perhaps to the United States. We have this looming tariff threat, as you mentioned. We have a degree of political instability, but we have been able to export our debt to foreign investors, and that has been quite helpful. It's been a real balm or salve for the debt markets here in Canada.
You know, one might think that despite the uncertainties currently facing Canada, we have a long record of making good on our debt obligations. We pay the interest. We've never defaulted on our debt. We're a stable democracy despite the uncertainty in Ottawa right now. We have a strong economy despite the weakness that the economy is experiencing. Why is it a surprise that foreign investors would ramp up their purchases of foreign debt? I guess they've got other options that would check all those boxes. Is that correct?
So I guess the first point is, is it a surprise? And I'd say, not necessarily. What we're seeing is extraordinary. Is it surprising? Not necessarily. One, we have more debt to issue, let's be honest. So we have a deficit in the nation's capital, I think, as most viewers appreciate. So there's more funding to do. There's more bonds available to investors. So to some extent, we have a supply impulse. And importantly, we look for whether we're able to place those bonds, that debt, with investors without really creating indigestion. And this is where the non-resident buying binge has really been quite striking. Now, what are investors drawn to? As you mentioned, I mean, there's nothing really wrong with the credit fundamentals of the sovereign government. I think most, again, investors appreciate that the Government of Canada is a strong, stable, sovereign credit. I think investors are also encouraged by the progress towards interest rate relief that the Bank of Canada has been able to deliver. Inflation doesn't appear to be a long-lasting worry for Canada. And critically, we really just have a more sustainable fiscal setup than some other peers. So again, from a risk assessment perspective, there's still a lot to like about Canada.
Explain what we're looking at on our screen right now. This comes directly from your report. It was written by yourself and Taylor Schleich. What are we looking at here? Explain those four bars from left to right.
Yeah, so I've touched on this already. So the net issuance on the far left, that's just the amount of funding that the federal government is doing. And again, that is largely a function of the deficit that the federal government runs. Now, we also know that at the Bank of Canada, they've been running off or reducing their holdings of Government of Canada bonds. So those bonds we need to find homes for those bonds as well. So those two bars together are the amount of sort of effective issuance to end investors. So we can sell those bonds to domestic investors or to foreign investors. And domestic investors are buying Government of Canada debt as well. They're increasing their holdings, and that's, again, also encouraging. But 80% of the net issuance has been placed with foreign investors. And I guess, one way to think about this is think where Government of Canada bond yields might be, for instance, if there wasn't that demand. We would presumably have higher interest rates, higher borrowing costs for the government and other issuers that benchmark themselves perhaps off of the government. So that's how you balance the market. And what we're seeing right now is a pretty significant, that far right bar is showing you how significant the foreign investor appetite has been.
The Bank of Canada has said that the end of QT, quantitative tightening, is coming, and it will not usher in a period of bond buying by the Bank of Canada. So that's a factor here as well, right?
Yeah, so the Bank of Canada has been quite transparent in terms of their playbook and how they're going to sequence things once they end quantitative tightening. Bond buying is not not the first stop, right? So they're going to do term repos. They're going to buy some treasury bills. Bonds will eventually be bought again by the Bank of Canada, but that's sometime down the road. So again, in the bond market, in the intervening period, we've got deficits to finance and a Bank of Canada bond runoff to contend with. So we need to find buyers, and thankfully they've been showing up in record numbers in the United States and in Europe and in other foreign locations.